Bim, what's up folks? Nick Musunda here, video number 17. In this video, talking about premixed investment options in superannuation, what they are, why they're important, and why should you listen to me. I've been working in personal finance for almost 7 years and looking to basically use some of that knowledge to help people with making more informed decisions about their own finances. So just to begin with, I'll give a quick description of what superannuation is, what super is for short. Basically, it's mandatory retirement savings in Australia. So all employers have to pay 11% on top of their employees' wages to their employees' superannuation fund. Okay, and then that money can be accessed at retirement age, or if that person meets a condition of release. So the money that goes into the superannuation fund is invested for the client by the super fund. And the way they invest it depends on what instructions they're given, but they offer typically a range of premixed options, which I want to talk about today. So premixed options, when you look at them, there's typically going to be something along the lines of a conservative option, balanced option, growth, and high growth. Okay, that would be pretty typical. Now, the performance of each of these pre-mixed investment options increases as you go along the list: conservative, balanced, growth, high growth. High growth having the highest potential for return. So the question for some people would be, well, why wouldn't you just invest? Well, why wouldn't everyone just invest in the high growth option if that's going to give them the biggest return and give them the largest account balance at retirement time? Okay, the reason they don't do this is risk. Okay, the risk is also increasing from being the lowest in the conservative option and getting higher in balanced, higher again in growth, and it's at its highest in a high growth type option. So why is risk important, and what is risk is probably something that we need to talk about as well. So risk, or volatility, which is a proxy for risk in the investment world, volatility being how much the price of something goes up and down. Okay, so if something's very risky, it's going to have a lot of volatility in the investment world. So whether it be a stock, whether it be a market index, anything that you could potentially invest in. Now, when someone's account balance is going down, it can create a level of anxiety, depending on how risk tolerant that person is. Now, the risk here is that if the account balance goes down, the person may liquidate their balance while it's low and crystallize a loss. So if you sell all your assets while the balance is low, you're in cash, your balance is not going to change after that. If you sell all your assets when your balance is high, the money goes into cash at that level and it doesn't change after that. So obviously we want to sell all our assets when the account balance is high. We don't want to sell when the account balance is low. Now, if you have an account that's going up and down more than you're comfortable with, it's more volatile than what is aligned with your risk tolerance, and you do, well, then you may liquidate your investments when the account balance is low due to fear of it not recovering in price, or staying low for what you think may be an extended period of time. The other reason you may liquidate your investments is because you just need the cash, right? You've got expenses that you need to take care of. So we need to make sure that the risk of the portfolio is appropriate for that person's risk tolerance and also that person's investment timeline. So this is why risk is important. And it's clearly, obviously, a trade-off. You get less volatility in your account when you have lower potential for return. Okay, now the other thing that people don't take as much notice of when they first start looking into the performance of their super funds is fees. Fees is another thing that needs to be taken into consideration. If you look at the product disclosure statement of any superannuation fund product, in the fee section, you'll always see the warning, which basically says that if your account has fees of 2% of the balance, and that's reduced to 1%, it will equate to a 20% larger account balance 30 years later if you retire in that time frame. So basically it's saying that drop of 1%, which would seem small at face value, will lead to a 20% difference in your account balance 30 years later. So that's pretty substantial, obviously, because of the compounding that occurs over those 3 decades. So small differences can make for significant differences at retirement time. Okay, so with that being said, I just wanted to have a quick look on the Finder website, which I think is a very useful tool for comparing superannuation funds. My main message, I guess, in this video will be that the premix investment option that you choose is going to be way more impactful on your experience and your returns than the super fund that you choose. Okay, and it doesn't make sense to compare a conservative investment option with, say, a growth investment option, because the conservative option is going to be exposed to much less risk and therefore have less potential return than the growth option. So looking on the Finder website here, I'm going to look just at conservative investment options. Please select that. And I'm going to rank them in terms of 10-year performance. Okay, now you can see here, the first thing I want to draw your attention to is that these are not actually conservative options. These are moderate investment options. So we're not comparing apples with apples. This is not a conservative option. It's going to be exposed to more growth assets than a conservative option. Balanced, MySuper, conservative balanced. So this is somewhere between conservative and balanced. Conservative balanced. Okay, so the Aware Super conservative option is the first, what would seem to be truly conservative option here. That's showing up in the list. So they're coming in at 5.28% return over the last 10 years. Hest is the same. That's a conservative option. So yeah, there you go. Telstra conservative option. It's not doing as well as its moderate options up here. Okay, now I took a, let's call it random sample of conservative options from the list, and I've ranked them here in terms of return over the last 10 years. You've also got their exposure to growth assets here and fees on a 50k balance across a year. Comment on growth assets. What are growth assets? Growth assets are riskier asset classes which have greater potential for return. So things like stocks, property, some alternative assets, things of that nature, they're growth assets. And defensive assets, which are low in risk and also low in potential return, would be things like cash, bonds, fixed interests, term deposits, things of that nature. Okay. Now, this percentage here that we can see is how much of your portfolio is being invested in growth assets. So 100% means all growth assets. 90% are growth assets, 10% are defensive assets, etc. Now, you can see that these are all around 90-something%, give or take, growth assets. And the performance is typically about 8-9%, okay, with the exception of Perpetual here, which isn't looking great. And you've got a bit of a, well, look, the fees are pretty comparable for the most part. Again, Perpetual's quite high, so sorry, Perpetual, you're not looking too good at the moment. But point being, similar exposure to growth assets, similar performance. Okay, now if we look at conservative options, comparable exposure to growth assets, it's about 40% give or take across these, and comparable performance. So you can see here, compared to the high growth, which was around 90% growth assets, 8 to 9% annual return over the last 10 years. With the conservative options, you've got about 40% growth assets, and the performance is much lower, about 4 or 5% over the last 10 years. Okay, so you can see how it would make no sense to compare a conservative investment option with a growth investment option. And the other thing I want to say here is that this is why I don't think it's as important which fund you're with. If you're with one of these major funds, because the investment methodologies are quite similar, you just have to make sure that you've got an appropriate level of risk exposure or exposure to growth assets, and then you can know that you're going to get a certain return because of it. Okay, rather than worrying about which fund is the best, make sure that you are invested in an appropriate pre-mixed option for your risk tolerance and your investment goals and your timeline and that sort of thing. Obviously, if this is a little complicated, you can always go and get some advice from a financial advisor. But yeah, that's pretty much the message that I wanted to get across in this video, guys. Hopefully you learned something. Thanks for watching.